Now, this is different from a letter of credit in that, first of all, the importer doesn't have to pay for the goods until the documents arrive. He doesn't have to pay for the goods in advance. The second way that it is different from a letter of credit is that there is no guarantee from the importer's bank, no responsibility to pay. Remember I said that 80% of letters of credit have discrepancies? Well, guess what? The importer's bank has no obligation to pay in those cases. So, if you're going to have a letter of credit with discrepancies more than likely, then why not use a documentary collection and know how much it's going to cost in advance? The importer's bank, once he receives the money, sends the money to your bank, doesn't have to have a correspondent relationship necessarily. The money is then sent to you. This is what a documentary collection used to look like in the olden days when we actually used typewriters. I put it up here simply as an example. I used First Wachovia because First Wachovia only existed for about a year. But a collection letter is basically the exporter's letter to the foreign bank asking the foreign bank to collect the money on their behalf. Let's go back to this slide. Let's say that your buyer needs 30 days to pay. You can actually make the draft of the documentary collection payable 30 days after sight, 30 days after shipment, or 30 days in the future. So when you send your documentary collection, your buyer needs 30 days to pay, you can tell that bank, deliver the document upon acceptance. What the importer will do is sign a promissory note, and the foreign bank will then send you a notification of when that payment is going to be made. Now, what I like about that is it takes the payment term out of my importer's accounts payable department, and there is an obligation for my importer to pay on a specific date. That way, I know when that money is going to be paid by my importer. If I am quoting in foreign currency, I can enter into a forward contract knowing exactly when that money is going to be paid to me. Now, let's say, for example, that you ship the goods and your buyer does not come in and pay the money. Or you ship the goods, your buyer signs the promissory note for 30 days in advance, and in 30 days they don't come in and pay the money. What happens then? Well, the answer to that is credit insurance. I believe strongly in credit insurance. I represent private insurance as well as the Export-Import Bank of the United States. Right now, private insurance is difficult to get because of the economic times. But because EXIM is a U.S. government organization and not profit motivated, their motivation is to ship U.S. goods overseas, receive our money back, and to create jobs through export. So for that reason, their underwriting philosophy has not changed. In fact, their rates were lowered 15% 2 years ago. So EXIM supports exports, and EXIM is one of the best kept secrets in the U.S. government. Let's talk about this situation where your buyer, has to pay at sight and doesn't come in and pay. What happens in that case if you have credit insurance? EXIM Bank will pay you 60%. Why 60%? Because you still own the goods. You own the goods, your buyer didn't pay, you can sell them to someone else at a discount, you can bring them back, but you will receive 60% from the U.S. government in the event that your buyer doesn't pay. Now let's use the example of 30 days. Your buyer comes in, picks up the documents, signs a promissory note. In 30 days, he doesn't come in and pay. In that case, you can file a claim with the U.S. government and be paid 95%. Credit insurance allows you to ship on open account terms instead of cash in advance, which then will enable your buyer to have the terms that he needs to pay you, which will also enable you to be more competitive. It also allows you to go into riskier markets. For example, maybe you've been selling into Canada and Mexico and you feel fairly comfortable with that, but you get an inquiry from Turkey or Russia and you're a little bit uncomfortable because you don't know these people, it's a very large order, and it's very risky. You know that export orders typically are much larger than domestic orders. So you're a little bit reluctant to take this order. If you have credit insurance, you can make sure that your buyer is approved either by the private insurer or by the U.S. government. If your buyer is approved, then you will be able to ship on open account terms, or my favorite way, through documentary collections, knowing that you will be paid. If you ship your goods overseas, either on open account or through documentary collection, and your buyer doesn't pay you for any reason other than product dispute, the U.S. government will pay you 95% of the bottom line value of that invoice. Now, what does that mean? That means the cost of the product, that means inland transportation, that means ocean transportation, insurance, that means if you have to send a technician over there, that means anything that is listed on that invoice. If your buyer doesn't pay for any reason other than product dispute, the U.S. government will pay you 95%. If you have private insurance, the private insurance will pay you 90%. There is a deductible with private insurance. Sometimes there's a deductible with EXIM insurance. It depends on the size of your company. It is also protection against political as well as commercial risk. For example, in the 80s, the peso was devalued in Mexico. Your buyer may have been very willing to pay you, but suddenly it was going to cost 2 times what he originally estimated to pay you because the peso had been cut in half, and your buyer may not have had that much money to pay. So in that case, the U.S. government again would step up to the plate and pay you. It's no fault of your buyer that they weren't able to pay you. It is purely based on a political situation. If there's an overthrow of the government, if there's a coup, if there's any political situation that prevents your buyer from paying you, you will be paid if you have credit insurance. Benefits of credit insurance also include financing. It's very hard to get loans from banks these days because they're a little bit reluctant. If you go to the bank with foreign receivables, the bank is definitely not going to want to loan against those receivables. If you go to the bank with foreign receivables covered by credit insurance, especially credit insurance underwritten by the U.S. government, the bank is willing to advance you against those receivables. What that means is you can include them in your borrowing base. You can assign the proceeds of your policy to a factor and be paid the next day. It also allows you to get either an SBA or an EXIM working capital loan in order to produce